right, what is up, guys? It is John Fibonacci. Welcome to my YouTube channel. I'm throwing in another video on opening price, but this time we're going to be talking about the importance of the New York Stock Exchange opening price. So, not really going to be focused on Forex today. This is going to be predominantly for the indices. We'll be taking a look at the S&P. All right, at least when we get to the examples. All right, the importance of the New York Stock Exchange opening price. We're going to be discussing why it's important. And for those of you that don't know, it's 9:30 a.m. EST. I'm in Central Time, so on my chart, you're going to see it at 8:30 a.m. Discuss a little bit about my personal trading view indicator. It's free to use. I don't have any paid indicators. It's for you guys. All right. And then, like I said just a moment ago, we're going to be looking at the S&P 500 futures examples. I know most traders, when they get into trading, a lot of them get into CFDs. So that's going to be like SPX or SPX 500, US 30, NAS 100, and stuff like that. It'll be applicable to those. I don't trade those. I really trade the micro E-mini index futures. All right. So, but if that's what you trade, then that's what you trade. All right. Why the New York Stock Exchange opening price is important. When a bull market is likely, the ideal scenario would be to buy below the opening price. When a bear market is likely, the ideal scenario would be to short above the opening price. Now, when it comes to the indices, most people who know who I am, and out of all the things that I teach, when it comes to the indices, I really don't short that often, hardly ever. And I would really need something that's high probability for me to short, but I do 9 times out of 10 looking for a long position. All right. Now, yes, there are seasons where, stocks have like these flash crashes and stuff like that. And obviously, shorting in that environment would be nice. I get it. But for normal day-to-day operations, I'm typically in favor of the long side more so than shorts. But even on this YouTube channel, you've seen me short the market before. If you looked at some of the relative strength analysis videos, you saw me short the market. So I do, but it's just for sake of clarity, right? Like if you look at the weekly and daily time frames for the indices, the overall stocks, they're usually pointed in the up direction. They're usually bullish over the long term, and that's kind of why. All right, so I always have to put that in there because it's important to me. So I'm gonna let it be known. All right, so what I look at, what I do is basically have the opening price. So right at 8:30 Central, right at 9:30 Eastern Standard Time, I will take a line and just note that price, whatever it may be. The price itself to me may not have to be important. Like it doesn't have to be a certain price, even or odd or nothing like that. I just want to know what the opening price is. And then when price action, starts to trade up or down or sideways, whatever the case is, if I'm looking for a buy position, ideally I would want it below the opening price. Okay? And that would look just like this. So basically, from the start, we would potentially see the market trade lower, right? And then by the end of the afternoon or even at the end of the morning session, we would hopefully see the market trade above the opening price and hopefully beyond it, right? And then, we look to capture that move. So buying below the open and then exiting or taking partials above the opening price and, seeing if we can capture that move. All right, now obviously there's a lot more that goes into that, and we'll discuss that a little bit towards the end of the video as well. But for sake of keeping it simple and giving you the general idea, this is what the idea is. And sometimes actually the market does do exactly this. How just like you see it in this image where it'll trade lower and then trade higher for the rest of the day or for the rest of the morning session, which is amazing, but you're not going to get that every day. All right. Now for bearish scenarios, it would be a little bit similar. It's not going to be like a direct inverse always, because I think that stocks fall faster than they rise. You know, what's that old saying? I forgot how it goes or who said it. Bulls take the stairs, bears jump out the window, right? Or bulls take the stairs, bears use the elevator, or whatever the case is. So I think it takes longer for stocks and indices to go higher than it does to go lower. And so that's kind of what I mean by that. Like, I don't think it's going to be a picture perfect inverse of down days where you'll see it trade higher and then gradually trade lower. I usually don't see it that picture perfect. All right, but the general idea is there, where you would have the opening price and then price action would trade above it, you know, to some type of area or liquidity, something like that. And then the market would look to trade lower for, up until the end of the morning session, or possibly until the end of the day. All right, just kind of depends. And then just for sake of clarity, the left side is a bullish day if we're anticipating a bullish day. And then on the right side, if we're anticipating a bearish day, then that's kind of what it looks like. Now, this does work on all time frames. I mean, it works for like 4-hour candles, 1-hour candles. It works for like weekly, monthly candles and stuff like that. That's fine if that's how you want to do it. But I think you get a lot of trading opportunities when you are a day trader. And as long as you're using the higher time frame bias, then I think the market from a day-to-day standpoint offers more trading opportunities if you're someone who likes to take more trades than, like, once a week or 2 or 3 times a month or something like that. So there you go. But we're really only going to be looking at day trades for this presentation. So if you want to study that, obviously you're going to have to pull up your own charts and go from there. So another thing to keep in mind, and you'll find this when you study and backtest anyway, but price does not always trade above or below the opening price. Sometimes price just runs without you. And yes, I'll show you an example of that as well. And, listen, markets fluctuate. You know what I mean? If they were picture perfect every single day, then it would be a whole lot easier to trade, and there wouldn't be 95% of traders who don't make money, right? So not every day is going to be perfect. Not every day is for trading, and that's actually kind of the point on this one, on the second point as well, is that I don't fear missing trades. It will happen. You just wait for a better setup. And we're not looking to trade every day anyway. I'm not waking up on Monday looking to trade and then again on Tuesday, Wednesday, Thursday, and Friday. I don't wake up and then anticipate, all right, I'm going to trade today. Like, that's not how it works. There are good days to trade. There are days where I would not want to trade. You know what I mean? I usually don't trade Fridays. I don't usually trade FOMC or interest rate decisions or non-farm payroll or anything like that. I tend to stay out of those majority of the time. I trade them sometimes, but more times than not, I would rather just pick some good days to trade. Tuesday, Wednesday, those are usually some good days to trade, and that's kind of goes for Forex as well. But yeah, so I had to put this in here too, just extra clarification. All right, so the John Phibbs London and New York Open indicator. I had this made, I think it was last year or maybe the year before that. It's real easy to find if you are someone who likes TradingView. I think pretty much everyone uses TradingView at this point in time. It didn't used to be like that back in like 2014, 2015. I don't even think TradingView was around in 2014. But anyways, if you go to tradingview.com, if you click that little FX button at the top and then you go to public library, all you have to do is search London and New York Open. You really don't even have to type in all of that. I typed in LON, and this is what came up under the public library. So right there, the yellow star, that's because it's in a favorite of mine. So there it is right there in the yellow box. You'll see my name, John Fibonacci. You'll see London and New York Open. And you will have London Open, New York Open, and the New York Stock Exchange opening price shown on your charts. Now be careful. Hold on, I'll get to that in just a second. Before I get to that, understand that when I had this indicator made, I had it only for London Open and New York Open for Forex, and I didn't have the New York Stock Exchange. So what I had to do is get a friend of mine from Trade House Costa Rica. He actually reprogrammed the indicator to actually add the New York Stock Exchange opening price. So Juan, if you're listening, I appreciate that. So shout out to you, broski. But yeah, so this indicator will display 3 opening prices, but you have to be careful if you're going to look at futures charts or if you're going to look at Forex charts and stuff like that, because for whatever reason, I don't know why futures does this, but the data is thrown off by an hour. So when you actually add this indicator, if you choose to do so, what I need you to do is go into the settings and make sure to align the correct times. A lot of us are in different time zones, and I don't know if the indicator like matches up with your time zone or if it's like an automatic. I don't know. I'm not a programmer or nothing like that. I didn't make this indicator. I had it made by someone else. All right. So, if you're going to back test it, you're going to have to do it right. So when you put this on your charts, just please make sure that you're looking at the correct times. Otherwise, it's not going to be correct. Okay? So now we get, I think, to everyone's fun part, which is the examples, right? Everyone wants to see the charts, so that's what we'll get to. And this is what the indicator looks like. You can actually see it at the top left. It says John Phibbs, London and New York Open indicator. And the orange line is what the indicator does. Okay, so like I said, it just plots the opening price right at 8:30, and then in the history, like when you actually look at this, it'll draw it out all the way until the end of the day, or whatever the indicator settings are, but you can change it. So I have it to where it ends at 3 o'clock Central or 4 p.m. Eastern. All right. So it's kind of like a sessions indicator almost, where you can kind of see the price action during the actual New York Stock Exchange. Okay. So again, that orange line is just plotting the open and then draws it out, and that's it. So it's not a overbought, oversold type of indicator. It's really not even it doesn't provide signals like, oh, buy this or short that or cross over this, cross over that. None of that type of business. It's literally just opening price. But like I said earlier, right, if you're looking to buy, then it would be ideal to buy below the open. Or if you're going to short, it would be ideal to short above the open. All right, so in this example, we actually see the market open, right? It does rally first. This is what I'm talking about, this black candle here, right? And I'll go ahead and throw this in here too, 9:30 a.m. Eastern, that's when this starts. Okay, so the exchange is open. We see price rally up, and then it quickly slams down here on this bearish candle, and then this next 5-minute candle trades lower down into this area here. Now, this is what's important. All right, so for this particular day, obviously this was the low of the day. This was pretty close to it, and then the market traded above the opening price. So, capturing a move like this, is not bad. You're not trying to get the low of the day, and you're probably not going to get the high of the day either, depending on obviously other factors. But if you can, snag the majority or at least half or more of the overall move, then that's not bad, and I think you're doing pretty good. All right. But I can give you a little bit more context as far as like what actually happened on this day, in my opinion. So this is going to be my interpretation of what happened on this particular day. All right, so I've told you guys about this before. Winning in the Commodities Market by George Angell. It was written or published in 1979. And I know there's other educators online who talk about, market manipulation, stop hunt, stop raids, and all of that. And it's not to take away from anyone else or anything like that. And to be honest, I agree with the majority of those educators who teach that type of stuff, because I have found it to be true in my trading and my trading results as well. So all in all, I do believe that the markets are manipulated. So if you actually have this book, or if you know someone who has it, you can borrow it. And if you turn to page 130, or it might be 133, but it's the third paragraph. And George Angell actually talks about how floor traders basically don't use stops, or some traders elect not to use stops because the floor traders will basically run stops, meaning that they're going to drive price to where stop losses are at, i.e., buy stops, sell stops, things like that, even trailing stops. And even though the context is a little bit different, it's still overall orders, right? If you're in a short position, you want to buy it back, your stop loss is going to be a buy stop, and then vice versa, right? So all in all, near the open, right, the first 30 minutes, the first 1 hour is usually, sometimes you'll see the most movement of the stock exchange. Okay, and that goes for stocks as well. But again, it's not going to be every day. You can get volatility throughout the day or even in the afternoon, but a lot of the times you'll see stuff like this where the exchange will open and you'll see heightened volatility. All right, so what we actually see in this scenario, all right, is if you look at the London session, we actually see a few lows down in there. There's about 3 or 4 different lows right there where the red line is at. And, this is seen as a support area. So if traders were in London, buying price as it's going higher, they're profiting, whatever, their stop loss or some type of trailing stop is going to be either at those lows, below the lows, or even following price as it's rallying higher. Maybe they have their stop down here, and then as price is rallying higher, maybe their trailing stop follows price, and that, whatever. Okay, but nonetheless, you kind of see what the market does here, right? Again, it does open, rally a little bit, but then it slams down and then slams down again, and then trades back up to this point. It does have a retracement. And then over the rest of the day, it gradually into the afternoon in here does trade back above the open. All right. So like, for example, we have more examples, don't get me wrong, but I'm just saying, like, if you want to look at this and back test it, you could say, all right, we did have manipulation here. Price rallies away, right? Price shows a response. Okay, that's fine. And then price comes down again. And that can be a potential buying opportunity, or even waiting for price to come back up here, and then a retracement down in this area. That can be seen as a potential buying opportunity as well. This YouTube channel, I've done a series on Fibonacci logic, and obviously you can apply that here, low to high, some type of 618 retracement, either in this area, or you could measure like this low up to this high. And this is a probably a 618 area as well, for that buying. So when you're actually looking at fib retracements, or even if you want to actually outright buy a potential run on stops, like if you believe the market's going to sweep this and trade higher, and you outright buy that, when you actually think about it, and this is like the key here, at least in my trading, when I look at either a concept or a fib retracement or some type, whatever the case is, however you analyze the market, if I'm looking to buy a retracement down in here, or even a retracement in this area, if we look at it and say, okay, where am I getting in, right? Whether it's a 618 or whatever concept, whatever the case is, right? Where is that? in relevance to the opening price. So if we draw fibs down in here, wherever we're electing to buy at, it's below the opening price. So if we were anticipating today, this particular day, to be a bullish day, then we would want to buy below the open. So you may not get the very low, but as long as you get in below the opening price on a day that does see higher pricing, then you can capture some move higher. Okay? So I know I kind of said a lot in there, but that's the idea. All right, so there it is. But for sake of conversation and clarification, this particular trading day, if you want to go back and look at it in your own charts, was August 9th of 2021. All right, so for me, that was actually about a week, maybe a week and a half ago. So you're more than welcome to go look at it for yourself. And as a matter of fact, I encourage you to do so. All right. Here is another trading day. I'm not sure which day this was, but this one is kind of picture perfect in terms of, that second or third slide I showed you where you would see price dip below the open and then trade higher into the afternoon, or like into the lunchtime, or into actually the closing of the exchange. So this day was honestly ideal for looking to buy below the open. Now, I actually remember this day, and me personally, I didn't get in because I did have a fib from this low up to this high, and I was anticipating a 618 retracement, and we actually didn't get that. And I was off, I think, by 1 point on the S&P, like 4 ticks. I was off by 4 ticks, and then the market took off without me, and then big bullish day, all right, that I just wasn't a part of. So, it happens. All right, sometimes you don't get in, sometimes you miss out, and that's just how it is. But for sake of example, this was beautiful. All right, so if I was looking to trade like a 50% retracement, or even from this high and this 50% retracement, that would have been beautiful, but it didn't happen. I didn't do it, so it's fine. All right, but beautiful example there on this particular day. We can look at another example. I'll kind of show you a shorting example. Like I said earlier, I predominantly go long, but I will also show you shorting opportunities. So we see here, right at the opening price, okay, we see the market rally up. And then on this candle, it comes back down. And then we kind of just float around the open for a little bit before drifting off into the afternoon or heading into that lunchtime area. The market actually traded lower, moved sideways for a little bit, and then traded even lower. So like the day prior, or even during this particular day, if you thought that this particular day was going to be bearish, then there was opportunities to actually trade price while it was still above the opening price. And just to give you a little bit more context here as well, we can actually see that there was a short-term high here, right, that did get swept. And you can see, right, the bodies of that are basically respecting this price level. So price that came up and then rejected one more time and then rejected. So this is kind of an indication that this was a potential stop run as well. All right, so on this day here, we actually see the market open. It doesn't trade below the open at all. It just opens, immediately trades higher, minor retracement, and then just drifts into a little bit after the lunchtime, and then heading into the close, it does actually drift off a little bit. But this was a bullish day predominantly, but there was no buying opportunity below the open, and there wasn't any really like major retracements that I would see as a buying opportunity. So again, that's why I threw that in here, because sometimes the market does take off and no buying opportunity was present. So it is what it is. All right. Okay, on this particular day, not bad. We saw a little bit of pre-market movement, right? The market trades higher and then opens. There's a little dip right there at the open. I'm not really too concerned with that. I wouldn't be buying that per se. We ended up trading higher again, right? So this nice leg higher here, okay, you can draw a fib from that low to this high, and then look at the market right here, okay? You see how we come back down below the open. We actually trade into this old price action here, so that's pretty relevant. Okay, there are people out there who do believe that old resistance is new support. That can be seen here, but I would be more so focused on not that particular way of thinking, but more so of, all right, we're also below the opening price again. And then we see the market response, and then a little bit of retracement here, and then it drifts higher heading into the close of the New York Stock Exchange. All right, so pretty interesting opportunity there for buying below the opening price for the New York Stock Exchange. So, just to kind of wrap this up, opening price is important, but a trader needs more than opening price alone. This is why I showed you a few different things, other concepts, other context, especially, and stuff like that. Consider other analysis like the Fibonacci logic, relative strength analysis, and or however else you analyze the markets. Okay, there's obviously many ways to look at the market, and the opening price is just another way of viewing the market, but not in a way where it's all that you need. You know what I mean? Like, I like having confluence, and that's usually how I trade, where I need, two, three, four different things to kind of point in the same direction and say, all right, this trade is probably considered higher probability, so I'll take that trade, but I need more. Okay, so with that being said, that is going to be all from me. I hope you enjoyed the video. Don't forget to like and subscribe so that way you don't miss future content. You can connect with me and my other social media by scanning this QR code. It'll take you to the link tree, and you can connect with me from there. All right, so have an amazing rest of your day, and I'll see you guys in the next video.